In this week's video, we'll review the latest charts and data that demonstrate that bullish odds are improving with new market leadership. We'll be moving quickly, so feel free to use the pause button on your video player. You may remember from last week's video that the original game plan was to do a little bit deeper dive into a review of 2022. It's not really in our best interest this week. There's too many developments that we need to cover and monitor to make sure that our capital is allocated properly. The 2022 review is complete. We'll either present that intra-week or hold off until next week. While the charts didn't look very good last week, we always want to maintain a balanced approach to help us keep an open mind. Two of the bullet points from last week's video talked about the fact that the December 22nd rally attempt was still alive as we headed into the new year, and it was important for us to keep an open mind that if the S&P 500 recaptured and held above 925-ish, that the major low case must be respected. We also talked about the possibility of a soft landing, and we'll cover some economic data this week. As noted on Twitter this week, second trading day of the year. If you compare and contrast many of the weekly charts at year end and 2 trading days into this year, there were some significant and noticeable changes. We'll cover a handful of those charts this week. Probably an understatement to say that last year was incredibly difficult for market participants. But history says following a year where everything for the most part gets whacked, eventually some wonderful opportunities start to present themselves. We've had somewhat of a mixed market. Things are improving, but we should also keep in mind the Nasdaq made a new bear market closing low just 7 trading days ago. January 5th tweet before NFP. It's difficult to make the case that we're currently in a recession. We've covered this topic in detail in the past, so we'll move very, very quickly. Data that the National Bureau of Economic Research uses to declare or determine when we're in a recession. The reality is, if we scroll through these charts, and all of these charts were pulled off of Fred after the market closed on Friday, and based on the data sets that have been used to determine whether or not we're in a recession in the past, it's very, very difficult to make the case that we're currently in a recession. Obviously, that may change, but it hasn't changed yet. The data on your screen may also be relevant going forward. In last week's video, we covered a lot of big picture charts that really just didn't look that good. But we also mentioned that a fair question might be, why do we own anything at this point? And the answer was, many of the charts just didn't look that bad yet. With very few exceptions, every chart that we cover this week will be dated January 6th, Friday, after the market closed. 200-day moving average in red, 50-day in blue. This chart would fit the category of, it just doesn't look that bad. If anything, this is consolidation in a constructive area, and momentum is trying to turn back up near the zero line. Obviously, the look of this chart can change very, very quickly if price moves into this area here, but that hasn't happened yet. And if you're familiar with weekly cloud charts, right now this has an improving look. These two charts can be used to illustrate where we are today and where we may be going from both a bullish perspective potentially and a bearish perspective. Both charts dated January 6th. Let's zoom in a little bit closer. As we just noted, the Nasdaq recently in late December made a new bear market closing low. So this is late December here. You're basically retesting the October low. Look at the Dow. Here's the October low here. Not even close to the October low in late December. So one possibility is this is similar to Q4 of 2008 and March of 2009. Many of your early leaders in that bull market made their lowest low in Q4 of 2008, and the S&P 500 and the other major indices came down and made a lower low in Q1, and the leaders made higher lows. So that's the bullish possibility, where this is a successful retest of the October low, And the NASDAQ walking forward, at least in the short run, will be a laggard, and the Dow would be a relative leader. So under that bullish scenario, what would we be looking for? Well, the Dow would move into this white space here, and the NASDAQ would start to look more like this chart over here. So this low would hold. The NASDAQ would start to morph into a look more like this over the next few days and more likely weeks or months. What's the other side of the ledger? The other side of the ledger is we're still in a bear market, and the Dow is going to break down and take on a look more like this over here. Not unusual in a bear market for your market leaders to take on an improved look and then fail. Some of the charts that we'll cover in the rest of the video will help us assess the odds relative to the bullish scenario and the bearish scenario. But the facts are, this chart looks pretty good over here. Here's a chart from the October 28th video. We said we could only check one bullish box at that time. This is one of your market leaders, VTV, value stocks. If we fast forward to the end of the week, January 6th, the close, how many of these bullish boxes can we check? Green above price, right here. Lagging span above price. Price above red. Price above red. Blue above red. Here's blue right here above red. Trying to simplify things. Price above the cloud. Price is above the cloud. Cloud shifts from red to green. Cloud shifts from red to green. In its present form, this chart looks pretty good. Now, it's possible this is somewhat of a failed breakout look. So the longer it holds, the more relevant it becomes. It looks quite a bit better than it did on October 28th. Very, very similar situation with SCHD. And these are some of the positions that we said last week just didn't look that bad. This is the 50-day all the way out to the 200-day. This, for the most part, is a full-bore bullish look, with blue the fastest moving average on top, price above all of the moving averages, and the slopes of the moving averages are either up or about to turn up. We can at least envision a full-bore bullish look. Right now, SCHD is holding at a very, very important area. The longer it holds, the more relevant it becomes. It would also be very relevant if we get a failed breakout look and we move down here. But right now, this looks good. Let's go back to VTV. This is a weekly chart. These are moving averages here. You can see the dotted moving averages. For the most part, when you're in an uptrend, you stay above them. Notice price held above all of them. Compare and contrast this look here to this look here during the financial crisis bear market. And even this look here when the rally attempt failed in 2015 and we came back and made the final low in February of 2016. If we zoom in, anchored volume average weighted price. This basically says is the average person that bought between point A and point B. Orange line, point A and point B. Moral of the story is, on average, relative to volume, they're all profitable. That for the most part means they have incentive to add to this position. The longer we stay above all of this here, the more relevant it becomes. This is another chart. It just doesn't look that bad in its present form. That may change, hasn't changed yet. This look here, keep this in mind. Your market leaders within the context of a bear market can take on improved looks and then fail. Improved look and then fail. 2002, 2001. The longer these looks hold, the more relevant they become. Not making any assumptions about what they look like next week or in 3 weeks. Let's double back to the recession question. You can pause your video player here and look at this in more detail. Study that we completed this week. This is U.S. ISM manufacturing. It's the prices paid index, so think inflation related. It recently plunged from above 80 to below 40. That's pretty rare. I have data here going back to 1948. It's only happened a handful of times. Median drawdown following something similar in the past, roughly 2%. Average, about 8%. So think of it this way. Oversimplified. This is inflation plummeting, or at least some components of inflation. In every single case, the S&P 500 1 year later, from the day that you dropped below 40, the first data point below 40, S&P 500 was higher every time, average gain 16%, 2 years later 35%, 3 years later 52%, with two notable exceptions. 1982, the drawdown after the day of the signal was almost 10%, and 2008 keeps us honest. It's a 30% drawdown, but you're still higher a year later. But that's a big drawdown to tolerate. Tells us to keep an open mind about a wide range of outcomes, but for the most part, this leans bullish, and common sense tells us this leans bullish. Inflation is the biggest problem facing the markets right now. Doesn't guarantee anything, it speaks to probabilities. After Powell, James Bullard is one of the most influential Fed governors. This week he acknowledged that a soft landing is a higher probability outcome than it was in the fall. It's possible Powell will make similar remarks in his next public appearance. Possible. You can pause your video player here. Another chart that tells us to keep an open mind. The street is very, very bearish. So this would be keep the open mind about bullish outcomes. If you read this, this says don't assume inflation has turned just yet. What will guide us? The charts. If those good looks on SCHD, VTV, etc. remain in place, tells us a lot. If they fail, tells us a lot as well. Also good to keep in mind, the economist that showed the link between yield curve inversion and recessions says it's possible the yield curve is providing false signals. Possible. Covered this in the past. This is January 5th, but we have the data for January 6th. See this data point right here and this data point right here? January 6th was below that. So we're not really into the box yet, but if good things are going to happen, we should start to take on a look more like this or a look more like this over here. And that may happen very, very soon. How about new highs and new lows in general? Also good to know. During the dot-com bust bear market, NYSE, new 52-week highs minus new 52-week lows got as high as positive 328, 319, 277, 329, and those rallies failed. So in terms of paying closer attention, when you're above zero for any length of time, or flirting with zero, you pay closer attention. The longer you can stay above zero and the more that you can look like this, the higher the odds of good things happening. There's nothing magical about this data set or any data set. They're just part of the weight of the evidence. This 328 number here, around 11 a.m. Eastern Time, it was plus 38. Relevant enough to pay closer attention. It doesn't mean we're out of the woods just yet. Some other examples of charts that look good or at least don't look that bad. This is the Dow. Gold over here above all of the moving averages. An improving look, not that great. Quite a bit better than over here. There are value stocks over here in foreign developed markets. Look how much better this chart looks. Same moving averages, same date, relative to a current laggard, the NASDAQ. If you're a stock market bull, you want the NASDAQ to morph into a look more like this. If you're a stock market bear, you want this breakout to fail, and you want this chart to start to shift more back to a look like this. You want to look at things on multiple time frames. This is foreign value stocks on a daily time frame. Put a trend line on the weekly time frame, and you can see haven't cleared that yet. So this is an improving look. Still below a red cloud. This could be resistance here. This could be resistance here in the coming weeks. Improved, not perfect yet by any means. ACWX global stocks. This speaks to the dollar. This speaks to interest rates. It's an improving look here on the daily chart of ACWX. Weekly cloud looks a lot better. It looks better than any other point in calendar year 2022. Blue is above red. Green is above price. Price is above blue and red. This is a big hurdle here. This is all potential resistance, especially this area in here. Weekly momentum. Hard to make an argument in its present form that's a bad look, but it could be something like that. And look at this. Weekly MACD trying to clear the zero line. Longer it stays above, the more relevant it becomes. This is a hurdle. Anchored volume weighted average price for physical gold. Not a bad look here. The longer we stay above, the more relevant it becomes. But you can see, had a nice look here and we failed. But if we zoom out, from a risk-reward perspective, not a bad look. This is going all the way back to 1971. So if gold falls, you got potential support down here. And in the short run, you have potential support in here. Longer above, more relevant it becomes. This is where the S&P 500 closed on Friday, right in the middle of this band. So as we mentioned last week, if we can get to the other side of that band, the major low case starts to pick up traction from an odds perspective. A similar chart based on this low looked a lot better at the close on Friday than it did close on Thursday. Last time blue was above red weekly cloud, we had to go back to Q1 or January of last year. If this turn can hold, that's a good momentum look there. Still have a ton of potential resistance up here. You can see this has been a key battle area going all the way back to about December 22nd. This gap here, this is the nice looking candle at the close on Friday. Still, a lot of work to do. You don't want to make any assumptions about what happens here. Taking some nice baby steps. Here's another potential baby step. We've covered this in the past. This is your kind of ideal buy look here. Ideal buy look here. Still have some work to do, but you can see the slope of the 30-week is trying to flatten out here. The more it starts to look like this or this, the more relevant it becomes. In terms of the Fed interest rates and inflation, this is EEM, emerging markets, the same 30-week moving average. That is a nice look. Emerging market bonds have also done some nice things. The longer this holds, the more relevant it becomes. EEM, emerging market stocks, look at monthly momentum. You can compare it to past major lows in the S&P 500. Doesn't guarantee us anything. Also an improving look from a potential resistance perspective at the close on January 6th. And also a more constructive look on the monthly cloud. Back above the cloud, back above blue. The longer it holds, the more relevant it becomes. This was the 30-week with emerging markets stocks. Similar and much more constructive look relative to back here for emerging market bonds. This has a little bit more work to do. We don't want to assume anything. There's no question, though. This look here looks better than any time here. This is December. Doesn't look good in here. Didn't make it here. Doesn't look good in here. This presence form looks quite a bit better. You can pause your video player here. It's hard to make the argument that holding above the 50-month moving average is a bad thing. Right now, we are. It's possible this and this morph into this and this. It's also possible we're going to hold here. Monthly momentum, January 6th, still concerning. Looks quite a bit like this and this. However, 1982, we were in a similar area and we held. 1978, we were in a similar area and we reversed. Similar after the 1987 crash. So let's just see what happens here. Helps us keep an open mind about a wide range of outcomes. If you're a stock market bull, you'd like to see a look like this, this, or this. Weekly, intra-week has been down here more than once. It's closing above. Momentum here. This looks better than this in here. Has work to do, but if it can get to the other side, that would be good. Here's that gap again with price action. Longer we hold that look, the more relevant it becomes. There's work to be done here. This really doesn't support the bullish case in its present form. Hence, baby steps, small incremental moves, bigger incremental moves if we start to clear some of these hurdles. Similar situation here. Not enough improvement on this chart yet. Still haven't even cleared 39.14-ish here on the daily. By no means has the bearish door been closed for the S&P 500. There's just a much bigger crack in the bullish door as of January 6th. Equal weight S&P 500. This is the 50-day moving average here, simple 200 in red. This is a pretty important point. Right now, that looks pretty good. Hasn't rolled over yet in a significant manner, but unquestionably looking more vulnerable. This is interest rates. You can pause your video player here. 2-year yield, this is the daily cloud. It is red. Starting to check some bearish boxes here. Speaks to expectations about Fed policy. Tight clustery look here on the daily. Momentum weak. If you get in here, it would be good for stocks. Stock market bears want to get back out here, and you want to move back here. We're always looking for subtle shifts. S&P 500 peaks on October 16th here. This is the look of the 10-year yield. This looks different now. It looks similar. Now it looks a little bit different. This looks more constructive. This looks less constructive. Speaks to odds. Deteriorating odds for the 10-year yield pushing higher. Yields, bond prices move in opposite directions. Can make an argument that this is the most constructive look for IEF going all the way back into last year, or I should say 2021 now, that we've rolled over to 2023. Daily chart is above a green cloud. If you're a stock market bear, you want this look to come back. TLT weekly never closes above the center line on the Bollinger Band. Starting to look a little bit better in here, and some improving momentum looks as well. Trend line, break above it. Right now, this looks like a retest of that breakout, and we're back above it. Nothing earth-shattering, but it looks better than pretty much all of this in here. TLT monthly momentum, RSI the most oversold down here in its history. It goes back here to 2004. From a risk-reward perspective, owning some TLT, adding to it in a small manner seems to be a pretty good proposition. I have to caveat that with, this is unquestionably still in a downtrend. Amazon relative to the S&P 500, here's a big gap here that was never filled in 2017. The ratio came back to it. This is the close on Friday. If you're a stock market bull, you want to move in this direction. If you're a bear, you want to blow right through that gap. It's trying to make a stand at a relevant area. You can see we closed well off the low, plus 1.24 on the session. This is the daily low down here in the gap. Credit markets, improving look. Talked about this before. Now this is starting to pass the common sense test for some good things happening relative to inflation, the Fed, interest rates, and the stock market. Think lower risk divided by higher yield and higher risk. This is an improving look relative to risk tolerance. An improving look. Still has work to do. Corporate bonds, here's a gap here all the way back, COVID 2020. We have been up and down and around right now. Looks pretty constructive in its present form. We cleared the trend line. Step 3 would be exceeding this high. That may or may not happen. Convergence of multiple retracements in this general area thus far. Tip is trying to make a stand. Still in a downtrend. I have to say in its present form, this is a little concerning. January 6th, the end of the week, SPY underperformed IEF by 1.2%. Measured pace. Very indecisive look. We'll learn something either way in here. Similar and somewhat concerning look here. This is SPY divided by TLT monthly. It still has this really extended look, and year to date, SPY is underperforming TLT by almost 4%. Still in an uptrend, just noteworthy that this is a negative number up here. Marked up this chart for last week's video, and then yours truly copied it over to the wrong folder and we didn't cover it. However, we still had it in our arsenal this week. You can pause your video player. We've covered this for a long, long time. COVID low here. You can see prior to the low, we get rejected at this line. We cross the 200-week here, rejected at the same trend line, and then eventually cross. Here's a low here. This also coincides with the low in 2016 in the S&P 500. Right now, it appears that the same trend line is at least having price stall. This is December 30th. No real resolution here yet. In fact, XLP for the full week edged out SPY. Indecisive will learn something either way. Hence the somewhat measured moves on Friday relative to redeploying capital. Last week, this looked like a bullish breakout for defensive XLV relative to the S&P 500. This week, it looks a little bit like this reversal at the COVID low in the S&P 500. And momentum starting to look a little bit more vulnerable in here for the defensive asset relative to the S&P 500. The good news for bears, this ratio is still clearly in a weekly uptrend. Checks all the bullish boxes for the cloud. It's a small incremental shift, possibly. Doesn't really take on any meaning if the ratio gets out here and stays there, then it's still defensive looking and bearish. It's late on Friday evening, going to move through these quickly. You can pause your video player. Kind of an odd feeling watching the tape this week. Nothing was really happening, but the market had a bullish undertone to it. It said you should be ready for something good to happen possibly. And it was odd. Many of the weekly charts looked terrible at the end of last week. And then just 2 trading days into the year, they looked noticeably better. We did break this short-term range and it broke to the upside. The improvements that we've covered, there's steps. There's a lot more hurdles that may or may not be cleared. All of that, the longer you're above them or stay in a cleared mode, the more relevant it becomes. If it takes on a failed look, then that's relevant too. We learned something about bearish probabilities in every single case. If these improvements continue, we could be redeploying capital rapidly. We're just not quite there yet. We talked about this concept with the NASDAQ and Dow charts. New leadership would be logical. It speaks to a shift in interest rates, lots of shifts. Some of them we'll cover in that deeper dive in the review of 2022. If we have new leadership, for the most part, that's a good thing. Why? Because tech valuations were so extended. If some of these other areas of the market, dividend stocks, emerging markets, emerging market bonds, value stocks, the Dow, if they lead from a valuation perspective, they're in a much, much better spot in terms of margin of safety. There's no question some data sets related to inflation have plummeted. We covered one of them. There's a reason why we mentioned that there was still a window for a soft landing. The economy just doesn't look that bad. Covered this topic. We covered these topics. We'll learn a lot relative to these bullet points. Next few weeks, extremely important. If the improvement continues, we're going to be in very, very good, potentially risk-reward spots. One of the ways that you can tell readily that it's full-bore risk on is when the opportunities that you have, the list is extremely long, and the list has been getting longer. Regardless of what happens, what we're seeing here says we are most likely getting closer to better days in the markets. In fact, some of the major indices may go on to make lower lows. The leaders probably would not. Doesn't mean they wouldn't get hit again. They just probably wouldn't make lower lows. Go back and look at 2008, 2009. Haven't cleared this yet. We have a possible inflection point look. All of this is still relevant. And thus, we all know, the only way any of this is going to work is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.